All right, so we're going to use our previous example in the entry section, and we're going to use that for going over the improving our average and discussing what that looks like. So again, visuals for me always helped, so I thought it would be a good place to kind of explain that visually, right? So we talked about essentially the best area for entry that day was going to be as price came down and essentially tested the value area low area from the previous day. So the value area low and the POC as it came down, and it tested those areas and broke down, but not essentially reversing after momentum had moved back to the upside. And so that's what we've got here. So I've got market replay running, which again is an awesome feature in Sierra chart, and I'm sure the other ones have it as well. But to just go through and replay the trade or the day again, or to get additional practice outside of the traditional trading hours, and go back through and just tinker with the price action and with your entries and with your stops to really trade. So you have a day that you trade and it wasn't the best, right? To go back through and trade it the way that you feel like you should have traded it, while paying attention to those markers of why and what you missed and the things that you didn't see because maybe you were looking at things subjectively or whatnot, I think really is good, meaningful practice, and I think does help over the long term, as compared to just trading on a kind of a typical practice platform with no, essentially not replaying what you already have done or practicing your specific scenario without money, as I've discussed. So anyway, so let's take a look at this. All right, so essentially you can see my average entry area is right here at 1270. Okay, and so we've got our stop is down here, just below the -1 SD band of the VWAP. Because if price continues to break down at this point, right, we just don't want to be in the trade anymore. More than likely, this would end up being a consolidation type day. And so at that point, price would come back down and we're just in a giant whipsaw, which, as I think I've explained, is really not my cup of tea. I like to be targeting the trend at all times. And so that's how I trade. And so as best as I can, I try to avoid those balance type days. All right, so what we're looking at is essentially a 50-point stop in the NASDAQ for each one of these contracts I have put on. And so a 50-point target, based on what we're seeing, I don't think is unreasonable. All right, so we're going to go ahead and place our sell stop limit order here around the 120 area. There we go. So that looks good for one contract. And then, so as price plays out, we're going to see how this comes together, right? So again, as we talked about in the slideshow, was that, okay, we have 3 contracts at essentially this 12,070 area, and then we have our stop is at 12,000, essentially 20, so that's 150 points risk total, right, between 3 contracts, right? 50 times 3, 150. So now that we've set a first limit order to take a quick profit and price moves in our favor, when it hits that level, right, we now have 50 points profit, right? Now, at this point, once that has been removed and we have 50 points of profit, our stop risk for the last 2 remaining contracts will be 100 points, right? So we have 100 points risk, so let's put that in the negative category, and we have 50 points profit, so we're putting that in the positive category. So 50 plus a negative 100 ends up being negative 50, right? So by taking that small profit, we have now limited our risk on this trade while being able to keep the stop placement here and not moving it at all. We now have gone from 150 point stop risk to 50 point stop risk. And that, in my opinion, is incredibly powerful. And it allows us to leave our stop alone. It allows us for price action to develop in a meaningful way before we move our stop and not put it within the price action itself. Back to what we talk about, the three, where I take 3 losses on the day, right? So essentially we can see that price has changed direction actually about 4 times, right? So we had a price movement down, and then we had, which is where essentially we could have chased at any point in time, we could have chased these moves, right? So we could chase it down. Let's say we broke out, we decided to get short. We ended up taking a loss because things ultimately reversed. And then price moved back to the upside, and let's say we chased it here and we got long as price was breaking out here. Price came against us pretty good, and then let's say we decided to ditch the trade because we weren't placing our stops and our trade and our entry at a very advantageous level, and we were rushing it, and so we end up taking a stop through here from this trade. So that's 2 times on the day, right? And then now we're finally setting up things to be successful, right? But let's say our entry didn't work out again and price ran through to the downside, essentially stopping us out. That's where you get your 3 stops on the day, right? And as we discussed, the other 2 areas really should have been, if there were going to be an entry, it should have been a low risk entry and quickly being either taking that profit off or having a very tight stop on it just to limit it, right? But depending on how you're trading and how much you get caught up in the movement of the market and how rushed you are, you're letting the market move you into suboptimal action, those losses can happen very quickly, almost without your full consent, right? So that's why we really got to pay attention to what we're doing. But again, you can see how the market can easily whipsaw you into those places. And so if the market came down and it took me out here a 3rd time after I wasn't reading things objectively, and I took my loss here, I took another loss here, and then I took another loss here, at that point we're just walking away for the day, right? Because at 3 points, probably even less than 3 full losing trades, we're really not paying attention the way that we should. We're not seeing things as clearly, reading things objectively, and so at that point it's time to just be done and just to watch it. And then at that point later in the day or the week, and come back, replay it, take a look at what happened, take your notes, right? You should be journaling through the process, through the entire day, of why you were why you took the trade to begin with, why you decided to enter where you did, and where your stop placement was, and any emotions that were running or happening at the time, and ultimately how that worked out. And then we adjust or set safeguards in place so that we go next time when similar situation happens, we go, well, that wasn't following exactly what our ideal strategy is, so we need to keep an eye out for that specific scenario in the future, right? We're trying to prevent mistakes from happening twice, and if we can prevent it from happening twice, then at least we want to make the mistakes smaller, right? Not the same big mistakes that we've made. All right, and then the other thing I wanted to discuss was the slippage, right? And we talk about the slippage of, actually we had a good chance to talk about slippage for entries and stops on this one. And so if we had decided to either buy the market, or so for this trade would be sell at the market, as this big volume comes in and the bar rushes down. Even if we sell here, we may not get our entry until down here, right? And so that is eating at every step that we don't get our entry, that becomes a lower point of entry, becomes a higher point of potential risk of price moving against us, right? So that's what we need to be aware of there. Letting the market come back into our buy area, or at least volatility to chill out before we enter, will allow us to minimize that slippage. And then, like when price was coming back here, and we had talked about getting an entry in this area here, price came back through there. You're getting no, and we set a limit order there. You're getting no slippage through a process like that. Or if you are, when let's say you had your a limit entry here, and a bar runs through it quickly, you can actually get slippage in your favor, right? So that's the ultimate idea, would be to have the slippage work for you to where you get an entry 3 or 4 points better than what you had before. Doesn't happen often, but when you're targeting that pullback entry, then this is much more likely going to happen than it does here. This is essentially never going to happen. At least there's a chance here. We're stacking odds in our favor, right? And then also, if we had decided after we entered in this area and price moved down, if we had decided to put our stop essentially right above this price action, when this bar came in through here, depending on the velocity of that bar, and if it ripped through, because more than likely based on the bar there were a lot of stops that were placed here, if it ripped through there, we had our stop placed just above it, there's nothing saying that we couldn't have been filled potentially up here as that price vacuum essentially and volume dried up, and there's nobody to fill your order until price moves further away, right? So when we talk about slippage, that's what we're talking about there. I'm sure a lot of you are already familiar with that, but again, it's a good primer to go over and to make sure that there is a solid understanding there. So at this point, I'm going to speed up the replay because that's always cool. We're just going to watch this play out. This price action continues to work its way in our direction. All right, we're heading up towards the VWAP now. Price has made that poor low, and it is now breaking this resistance level here, and now we're coming back up and digesting the previous areas of support, right? We had kind of broken down below the value area low. Price failed to continue to the downside there. Now we're breaking out higher. This downtrend line was broken, so now we have several signs of failed price action, essentially to the downside, or at least weak price action. All right, so we're going to watch. You can watch the P&L over here. Continue to work its way higher, and so at that point, we're actually going to be. We should be around our stop. We should be at 150 points profit. Alright, continue to speed things up here until we get this to work out. Alright, and so now we can see that our profit target is actually clashing with the downtrend line. So if you're really putting a lot of weight on that downtrend line, then you may go, hey, I want to move this. All right, there we go. And the profit target was taken right before it hit the trend line. So at this point, if it hadn't hit it as price continues to move down, or the trend line continues to move down, you could adjust that lower if you really thought that it could potentially go down, or if you just wanted to make sure. I mean, we kind of want it to be a guaranteed thing. So anything that could be potentially in our way, and we see that there is, there was a reaction to this trend line, and there's nothing saying that price couldn't reverse there and taking a deeper pullback. right? At that point, we could have already had our profit off, and if it comes back down to this level, there's nothing saying that we can't add that back on as price becomes very, very low risk, and add that third contract back on, looking for another move to the upside, right? So now I'm going to pause it. At this point, you can see we've got essentially we've got our booked 50 points, right? And as we talked about before, our stops, we were able to leave our stop alone while improving our average. And at this point, we can actually move our stops higher because price is continuing to break out. We're getting later in the afternoon, and at this point, ideally, I would not like to see price break down below the value area low. And so we could just take this, slide this up here, give ourselves a little bit of room underneath this support level here. And then we've now tightened up our stop, but not in a significant way, not into the current price action, right? And so now we're just looking for price to continue to work its way out of this area, and then we will continue to trail our stop higher. All right, and then so that's essentially the idea behind the improving our average and taking risk out of the trade without having to move our stop into the current price action, moving our stop, getting rid of the idea of moving our stop to break even to reduce risk, when actually all it does is actually increase losses, which is increasing our risk over the course of time, and increasing our profitability overall. So anyways, again, hopefully you got some value out of that. Hopefully that visual example was a good help cement it in your mind, kind of the way that it works, or that it should work, and give you a scenario in which you'll have a reference point in the future. So I'll see you in the next section.